Welcome. My name is Jason Payne and I'm a CPA in Las Vegas, Nevada. I would like to briefly discuss with you today how to quickly tell if you will have to report taxable income on the short sale or foreclosure of your second home or your vacation home. The Internal Revenue Code is very complex and you will want to discuss your individual situation with your tax advisor. There are a few considerations you will want to factor in when making this decision. The short sale or foreclosure of a second home or vacation home is the worst of all scenarios. If you find yourself in this situation, you will want to plan ahead as far as possible. When you short sell or foreclose on a property, you will generally get a Form 1099. This will report to you the amount of debt the bank has forgiven. Generally, the amount reported on Form 1099 will be considered income, which will be taxable at your ordinary tax rates. A second home or a vacation home will not qualify for the Debt Relief Act as discussed in the clip on primary residences. Additionally, as a personal asset, the loss you sustain from selling the property for less than what you have purchased it for will not be deductible under the tax code. The IRS will not allow you to deduct the loss on the sale of any personal asset. You could think of this like your automobile. When you sell your car after several years of ownership, you are not allowed to deduct the loss you have for selling it for less than the amount you purchased it for. The same concept is true for short selling or foreclosing on a second home or a vacation home. The only way to potentially avoid having to report taxable income in this case is to look at whether you are insolvent or not by the IRS's definition. So, what does it mean to be insolvent according to the IRS? To be insolvent means that when you add up all of your debts and loans, they are greater than all of your assets. If you are going to report to the IRS that you are insolvent, you will need to be able to prove it. The test on whether you are insolvent or not is conducted immediately before you close on the short sale or the foreclosure. In order to prove to the IRS that you are insolvent, you will need to actually take out a piece of paper and on one side of the page list out all of your loans and all of your debts. This would include your credit card debt, the mortgage on the home you are about to short sell or foreclose, any car loans, student loans, and any other debt that you may have. On the opposite side of the page, you will need to write down all of the assets that you own. This would include all of the cash in your bank accounts, the cash in your 401k accounts, your IRA accounts, and any stock accounts that you may have. You will also include the value of the home that you are about to short sell or foreclose, and any other personal assets that you own, such as your car or household items. As long as the amount of your debts is greater than the amount of your assets, you will be considered insolvent. However, in order to avoid taxable income, your debts will need to be greater than your assets by at least the same amount that the bank is going to forgive in the short sale or foreclosure. If you feel that you may be insolvent, we ask that you actually write these amounts out and have it documented on paper before you give us a call or meet with us for a consultation. Unfortunately, we will not be able to advise you without this information. In conclusion, the short sale or foreclosure of a second home or a vacation home is the worst of all situations. You will want to speak to your tax advisor to determine if any additional tax planning can be done in order to try and reduce or eliminate taxable income. If you would like to speak to one of our CPAs about your specific situation, please feel free to give us a call at area code 702-233-9526. Thank you.